Thanks, April. Hi, everyone. Thanks for joining us. I'm John, and my colleague Jim Fearon is here, and we'll take you through the next 30 or 45 minutes through our salary guide and some of the observations of the marketplace. So we will first discuss our views on a global basis and then give some regional highlights, and then we'll talk in much more detail on the North American market and the U.S. in particular. As April said, you won't be able to ask any questions during the presentation, but if you have questions, please send them through the chat box to me, and we'll have some time at the end to answer any questions you might have. We'll also record the webinar if you want to review it or pass it on to anyone, and if you'd like a printed version of our salary guide, which goes into much greater detail than the presentation today, you can go to our website and request either a downloaded copy or a hard copy, and we'll give you some instructions on how to do that at the end of the presentation. So first, a brief introduction to Hays. Many of you know us. We're a leading global staffing and recruiting company. We're publicly traded, and this past year we had revenues of about $5 billion. We're a fairly large company. We work across most industries, including oil and gas, and we focus on helping our clients find the best professionals to hire either full-time or on a contract or temporary basis. We focus mostly on white-collar professionals in IT, engineering, finance and accounting, and scientific functional areas. And in addition to traditional recruiting and staffing, we are also a managed service provider, so clients outsource their recruitment processes and their temp and contractor management to us, and we provide RPO or MSP services. We also have a VMS platform called 3-Story Software, and so we implement technology platforms to help our clients run more effectively and efficiently. And worldwide, we have about 7,800 recruitment experts in 33 countries, and in a typical year, we'll place about 55,000 people in permanent roles and over 180,000 into temporary assignments across the world. This survey is created jointly with Oil and Gas Job Search, and Oil and Gas Job Search is one of the industry's leading job sites. They have a database containing over 750,000 industry professionals, and it's a great source of candidates for those of you looking to hire, and it's also a great place to look for positions if you are interested as well. I highly recommend you look at their website. It's oilandgasjobsearch.com. So a little bit about the survey. 5 years ago, we started publishing our salary guide in partnership with Oil and Gas Job Search. And our goal back then and still is to provide information regarding the trends in compensation and benefits, particularly as they vary from country to country. Last year, we had about 250,000 downloads of the document, so it appears to be a useful tool that's widely accessed and used. But certainly we're always looking to improve our service, so please let us know if you have any suggestions or comments, and we will try to incorporate them into next year's salary guide. This year's survey, we had 24,000 oil-field respondents conducted in the survey or respond to the survey, and they represent a good cross-section of the industry across 53 countries. We have 24 disciplines, functional disciplines covered, including reservoir characterization, petroleum engineering, subsea, project controls, and so forth. Before we get into some of the findings, let me talk about some of the limitations of the survey and its results. The salary guide should be used as an indicator of general trends in compensation, and it's not a precise measure or benchmark of compensation levels of any particular job, discipline, grade, or location. There are also a number of sources of error. For instance, from year to year, the changes in who responds to the survey, for instance, their seniority, their discipline, their location, and so forth, often have an impact, a significant impact on our published salaries and changes in salaries from year to year. Also changes in currency valuation. We report everything in US dollars, and we convert local currency to US dollars. So depending on the currency rate, that can also affect our results. This year, the U.S. dollar appreciated significantly against most other currencies, which has caused reported salaries of international workers to appear too low, abnormally low, when we report them in U.S. dollars. Given these shortcomings or possible sources of errors, we believe the guide is valuable in providing a general and global and a regional view of compensation trends. For more specific information, I suggest you talk with one of our recruitment consultants who focus on specific markets and disciplines and therefore have a very good view of the local labor market. So let's start from a global perspective. Overall, 2013, we saw sluggish economic growth in most of the world's economies. While economic growth has been good in places like the U.S. and Germany, places like Australia with its collapse in its mining industry, and the EU with stubbornly high unemployment in Southern Europe have still been struggling. So sluggish growth last year helped keep oil prices in a relatively narrow range between $90 and $100, $105 per barrel, which is above the standard $80 economic threshold, but below prices that would jeopardize the fragile global economic recovery. This, in turn, has led to somewhat of a cooling in the industry after several years of rapid growth and capital investment, and we have seen the first decrease in average salaries since we started our survey in 2009. And we'll talk about that more in the course of the presentation. However, even despite that we saw a decrease in average salaries, there exists dichotomy in the industry where highly skilled professionals, people with 5, 10, or more years of experience can still demand salary increases, whereas lower skilled workers faced this past year downward pressures in salary and compensation. The average salary of people, as I said, who responded to the survey this year dropped from last year. Taking into account the changes in demographics of the respondents and currency fluctuations, this translates to about a 1% decrease in salaries on a like-for-like basis. And on the chart on the left, you can see that. It's in the lighter blue. We've adjusted for currency changes and also changes in the respondents in the salary guide. So the light blue shows a decrease of roughly 1% last year on a like-for-like basis. In general, well, while some regions and skill sets still remain hot, we had other regions such as Australia and Canada to some degree taking a pause in activity. In general, high-demand skills like reservoir, petroleum, subsea engineering continued to see an increase in salary. So did skills in unconventional E&P. Conversely, most other disciplines were flat or saw slight declines in their salary based on the respondents to the survey. Overall, for many of you who've been in the industry for as long as I have, this is probably not a bad thing. It's probably a well-needed pause in salary growth, as rapidly increasing wages over the past few years have started to threaten the economic viability of some projects and some markets. For instance, the LNG and offshore services markets in Australia have come under a lot of cost pressure. So this flattening of salaries is probably no bad thing. Let me move on now to talk about some of the key trends and issues that have affected the industry over the past year, region by region. So first of all, in North America, as most or all of you know, the U.S. is projected to become the largest global producer of oil and gas in the world, and that's been driven by a surge in production from shale reserves. Imports of gas and oil into North America, into the U.S. in particular, have dropped by 32% and 15% in the past 5 years, and this has created a shifting and uncertain geopolitical environment for major oil-producing countries. However, many believe by the end of the decade, the unconventional bubble will burst and the importance of imports, particularly from the Middle East, will again rise. So that remains to be seen what happens over the next 10 years or so. Due to the surging unconventional gas production in North America and the U.S. in particular, natural gas prices have remained relatively low, which has decreased the attractiveness of drilling for dry gas, and it has also opened the opportunity to export LNG to higher-priced markets such as Asia. So the U.S. now is poised to become the world's largest exporter of LNG and LPG as well, and this has disrupted many of the global markets and many of the oil-producing countries worldwide. Domestically, in the meantime, low gas prices have greatly benefited the chemical and manufacturing industries as well as some others, which have announced new investments of as much as $110 billion over the coming years to benefit from the low cost of gas here in the U.S. And Jim will come back to North America. Jim will go in more detail in a few minutes. Moving south to South America and Latin America, Mexico has passed legislation to open its energy industry to outside investment, and they've done this in order to reverse steeply declining production, which has dropped 20% since 2002. If the law is implemented successfully, this could create significant activity, we believe, in the Gulf of Mexico, the Mexican Gulf of Mexico, and that's an area that's only been lightly explored compared to the U.S. portion of the Gulf of Mexico. Moving further south in Brazil, Petrobras is having difficulties financing its 5-year investment plan, which is very aggressive at over $200 billion. It's one of the world's largest corporate spending programs. This has delayed deepwater projects and has led to sales of some of its international assets, and last year was a relatively flat industry in terms of activity in Brazil. However, there's been successful licensing rounds at the end of last year for the pre-salt, and this has led to renewed optimism for 2014 activity levels. Colombia also had a successful licensing round at a more subdued level than Brazil, and exploration in that country has become a priority to boost diminishing reserves of crude oil. Both countries, Brazil and Colombia, are trying to reduce their dependency on international workers by attracting nationals who are currently working abroad. In Brazil, the government estimates it will need an additional 250,000 new professionals this decade, and it's initiated a program to attract and develop 200,000 of them, of the new workers. Despite this effort and despite a very youthful population, it's unclear whether there'll be sufficiently trained workers to fulfill their needs, and we believe that there's going to continue to be an influx of expats on the order of magnitude of 5,000 to 10,000 international transfers per year into Brazil. And then finally, further south in Argentina, the government has recently relaxed regulations enabling agreements to be put in place to develop the Vaca Muerta shale reserves, and Argentina is looking that shale production will help recover energy self-sufficiency, which it lost earlier in this century. So moving on to Europe and the North Sea. North Sea fields, average size, are shrinking very quickly, and increasingly the UK in particular is relying on NOCs, national oil companies, small operators, and service companies to keep production and tax revenues flowing. Nevertheless, there's considerable exploration work being conducted, especially on the Atlantic side of the North Sea, west of Shetland. The continued use of new technology is also propping up the EPC market with numerous upgrades to platforms and facilities planned and ongoing. And London in particular has emerged as a financing hub for smaller startup and mid-cap E&P businesses, exploring primarily in the North Sea and Africa to some degree. Over the last 12 months, we've seen a marked increase in smaller businesses securing finance from the capital markets in London to exploit recently acquired licenses. So London is certainly becoming the central hub for financing in E&P, or more so than in the past. Recently, the UK announced a new tax allowance aimed at boosting the development of shale gas resources in the country. If other countries in Europe, such as Poland, follow suit and overcome geological, political, environmental, and other hurdles related to shale production and fracking in particular, the global oil and gas industry would face a major rebalancing. Norway expects to continue high levels of spending, primarily offshore, although the service sector is experiencing a slowdown as companies have become more focused on increasing cash flow. The operating companies are starting to cut back on capital investments. So we are expecting a slowdown from the Norwegian sector over the course of the year from record levels in the past few years. So in general, in the UK and Europe, subsea engineers are in short supply, particularly those working in controls and pipelines. Geoscience and subsurface professionals, particularly with experience in the North Sea, are also in great demand. And some companies, in order to find scarce skills and combat salary inflation, some companies are looking to other industries for talent with transferable skills, such as ex-military personnel for operational roles or logistics roles. Moving further east, in Russia and the CIS, Russia relies on oil and gas-related duties and taxes, relies heavily on those taxes, and it's being threatened by the rebalancing of the global energy market. Exports from Russia have dropped due to European economic problems, as well as increased competition from cheaper alternatives, primarily coal from the U.S. Therefore, Russia's attention and gas exports might start shifting eastward to gas-hungry China. Many believe that Russia must invest in unconventional resources like the Arctic and shale in order to maintain long-term production, and this would require a significant inflow of technology and skills and probably as much as $100 billion in international investment. So it will remain to be seen if Russia pursues that path. As you know, there are protests going on in the Ukraine as we speak, and the outcome of these protests may have an impact on hiring for Russian and Ukrainian projects. And perhaps related to the protest, the Ukraine has been entering into shale gas production agreements with IOCs to reduce its dependence on Russian imports and possibly achieve energy self-sufficiency. However, shale efforts in neighboring Poland have had limited success due to a combination of geology, contractual terms, and environmental concerns. So it remains to be seen whether they will be successful there. Further south in the Caspian, we've seen activity continue at very high levels due to investment in transportation infrastructure in particular. Moving to the Middle East, OPEC has seen its exports decrease due to a combination of slow growth of global demand and surging production from the U.S. Given the expected return of production from places like Iran, Iraq, and Libya, OPEC will likely see continued declines in the short term. In the longer term, global oil demand is expected to grow from about 90 million barrels per day currently to about 115 million barrels per day by 2040 due to population growth and increased per capita energy consumption, primarily in developing countries. And if this happens, the Middle East, the expectation is the Middle East production will once again regain its dominance. Year 2013 was a relatively steady year for the Middle East, but given the number of infrastructure and field development projects that are now underway and have been approved, the expectation for 2014 is for much greater activity. The Middle East also relies on imported workers and will continue to do so for the foreseeable future, but there have been government and company efforts here to increase the local labor content of the workforce. These efforts have had some impact, limited impact, I would say, and the efforts have been supported by the demographic youth bulge in the population, but the increased activity will certainly be met by workers from other regions in the short term. We've been working with some of the national oil companies, and many of them have launched worldwide recruitment campaigns recently to attract the thousands of engineers that they expect to require in the coming years. Moving on to Africa, given its size and potentially untapped resource wealth, Africa is one of the last oil and gas frontiers. However, there are challenges in almost all respects. We find that candidates that we place into Africa are increasingly security conscious, and they are increasingly considering their safety and how potential employers are managing security at their facilities before they accept offers. Nevertheless, even with the challenges, capital investments in East and West Africa should continue as the huge potential there outweighs concerns about fiscal stability, security, and infrastructure. Historically, most of the E&P focus has been in the West, mainly offshore, but that focus is starting to shift somewhat to the East. Recently, there have been some significant gas finds in Mozambique and Tanzania, and also growing interest in oil in Uganda and Kenya. So we're seeing that deepwater skills here are still in demand, primarily for the West, mostly in reservoir and drilling engineering, but increasingly candidates with gas experience are being sought out for projects in the East. Moving to Asia, energy demand is expected to grow by 80% by 2035 in Southeast Asia, which will further shift the global center of gravity of the oil industry, further shifted eastward. Asia Pacific continues to be a region targeted by many of the global IOCs to achieve growth. Investment recently has been inhibited by challenging legal and ownership issues, raising capital, territorial disputes, infrastructure, and technical issues. The region must reduce regulatory uncertainties and offer some financial investment that compensate for the risks involved to really get international capital moving their way. But the outlook is very, very positive, as you'll see in a few minutes, for the coming year and next few years. Singapore has become one of Asia's main energy and petrochemical hubs and one of the world's top 3 oil trading and refining centers. It has great shipyard business, although the shipyards are coming under increased pressure from China. Singapore has their first LNG terminal coming online shortly, and therefore we're expecting to see an increase in demand for candidates with LNG experience. They'll need to be imported from other parts of the world. Design and construction of offshore structures also remains an expanding market. There's a shortage here of senior project managers, particularly those with subsea or surf background and mega project experience. The market is also tight for Asian national reservoir engineers, senior geophysicists, and geologists, because there's been a pretty strong effort by companies to hire Asian nationals as opposed to expats. Moving to Malaysia, the drive to invest and develop local talent continues, and this strategy has had some pretty significant impact, a positive impact on the talent available, particularly at the senior level. In the geoscience area, many senior roles have been historically occupied by expats. However, companies are now vying for talented local professionals, and in response to high demand and short supply, Malaysian candidates at mid to senior levels can negotiate large salary increases when moving from one company to another. Given the focus on employing local staff, expat salaries are under pressure, and we expect them to continue to be under pressure in the coming year. And finally, moving to China, in the upstream market, the EPC and other oilfield service companies have been relatively flat over the past year, and hiring has remained flat as well. In contrast, the downstream market, particularly the production of bitumen and lubricants, is booming, and sales and marketing professionals are in great demand there. And finally, the last region is Australia, and after a number of remarkable years of investment, there will likely be a pause in new LNG projects as U.S. exports are potentially more favorable from a pricing, contractual terms, and supply portfolio diversification standpoint. So new Australian opportunities for LNG expansion are going to have to overcome the high-cost environment as well as highly valued currency, which adds to the cost environment. In the marine sector, wages and expenses have risen significantly by about 40% since 2007, and these are only partially offset by rises in revenue of about 8%. So this has been raising concerns about the ongoing health and competitiveness of the offshore industry in Australia. Overall, the outlook for the economy there and the oil and gas industry in particular is pretty uncertain. I think we're going to have a bumpy couple of years there. We are seeing some increased hiring for LNG operators and maintenance people as the LNG projects that have been completed come online. So that wraps up the regional review, kind of a high-level review. Again, Jim will talk in more detail about what we've seen in the U.S. and North America. Moving to benefits, once again, the number of people receiving benefits has increased, according to the survey respondents. As candidate shortages continue to rise in certain markets and for certain skills, it's evident that employers are utilizing benefits such as bonuses as a mechanism for attracting top talent and then retaining it once they've attracted it. Employers who utilize their benefits as a key selling feature may be able to more effectively target this candidate pool in their recruitment plans. And bonuses in particular, particularly those related to performance, can be a very strong motivator of performance as well as a retention strategy, retention tool. In terms of anticipated staffing changes, projected headcount growth remains about the same as last year, indicative of, I would say, general confidence in the industry. The expected headcount growth is particularly high, as you can see on the right-hand side, particularly high in the Middle East, Asia, and South America, relatively stable in North America, and it has dropped pretty considerably in Australia and Russia and CIS. A few years ago, the industry's primary concerns were environment and safety due to the spill in the Gulf of Mexico, as well as economic uncertainty, and they were all about equally ranked in importance. And now, for the past couple of years, only skill shortages are the primary concern. The severity of these concerns varies by region, but there's concern pretty much across the board in all the developed nations on attracting and retaining key skills. Looking forward to 2014, for the past few years, employers have been consistently positive about the outlook for the industry. Over 70% of employers have a positive to very positive outlook moving into 2014, which is promising for us, although there is some doubt creeping into the industry. From a Hays standpoint, where we cross many different industries, we're optimistic about the global economy. As the global economy emerges from the economic downturn, we're increasingly seeing a more positive sentiment becoming established in more and more countries and across industries. Over the last 5 years, many businesses in many industries have been preoccupied with managing through the crisis and reducing costs. Recruitment has not been a priority on their agenda. This is now changing, and with a more positive and optimistic outlook, many organizations in a wide range of industries are reinvesting in their business and looking to recruit the skills they need to grow. At the same time, confidence is returning to the employee base, and an increasing number of candidates are now looking to move on to a new career, a new company to further their career. So despite this positivity, there is some doubt creeping into the industry regarding the high levels of capital spending and the return on these investments, and many of you have undoubtedly seen announcements recently about companies starting to curtail capital investments in the oil and gas industry. We expect that to continue and soften the market to some degree, but for the most part, we're pretty optimistic and pretty bullish about the industry. The consensus view is that the U.S. economy is going to continue to improve and grow at a relatively rapid rate, and the economies in the UK and other parts of Europe are poised to have very good years. In this scenario, energy prices should continue to remain within a relatively narrow band, again between $90 and $105, perhaps with some upside on the price, which would drive increased spending in 2014, probably in the single digits and probably 5% or less, but still a growth in the industry. And assuming this happens in 2014, we expect salaries to rise in the 5% range, once again with a wide variation between disciplines and countries. So before turning over to Jim and to talk about the U.S. and North America, let me just say a few things about some recruiting and talent attraction trends that we're seeing in the marketplace across industries. So a new generation is here, and it's now working. It's now part of the world of work. So Gen Y, and that's defined as those born between 1983 and 1995, now represent a significant and increasing percentage of the global labor market. And you can see on this chart about 42% of the respondents in this year's survey are Gen Y workers. So as the baby boomers and the Gen Xers start to leave the workforce, this generation, Gen Y, will take over the reins and be responsible for leading the worldwide economy. And certainly Gen Y workers will play an important role in solving this industry's skill shortages. Therefore, we believe it's critical for companies in the oil and gas industry to understand what motivates Gen Y so that they can most effectively attract, motivate, and retain these key workers. So we've conducted research recently that shed some light on Gen Y's attitudes toward issues surrounding their work and careers, what attracts them to a potential employer, and what makes them stay with that employer. So it's probably not surprising that our research shows that Gen Y across the globe differs from prior generations in terms of their needs and aspirations in the workplace and in their careers. By and large, they look for a more engaging employee value proposition than prior generations, and they value their flexibility in terms of when and where they work more than prior generations ever did. However, our research also shows that Gen Y differs considerably from region to region and from country to country. So for instance, while all Gen Ys want to be compensated fairly, wealth creation is much more important to those in China and Southeast Asia than the Gen Yers in the UK or US, where work-life balance and job satisfaction are equally important. So it's key to understand not only what it takes to attract Gen Y, but also how to create a work environment that keeps them engaged and keeps them with you for the long term. The Gen Y workforce is also certainly very comfortable with social media, and from our experience, companies must increasingly have a strong brand presence on various social media platforms, such as LinkedIn. This takes considerable effort, and this comes from firsthand experience that we have. It takes considerable effort to create a brand presence that compels workers, particularly Gen Yers, to want to work for you and want to stay with you. This is a rapidly changing landscape, the social media kind of industry, and it requires constant attention that should not be underestimated. Recruiting in the digital space increasingly means reaching audiences when and where they're available, and that means mobile technology. We've seen a dramatic uptick, as this chart shows, in the usage of mobile technologies by job seekers, and it's important that every company needs to consider, it's something that every company needs to consider as part of their talent attraction strategy. So by not having your jobs in a mobile environment could result in you missing out on active candidates who are searching over phones and tablets and so forth. We, for instance, are converting all of our websites to web-friendly platforms, and we see it as a critical trend in the future. So wrapping it up, and then I'll pass it on to Jim, 2014 is looking like a good year for the industry, for the oil and gas industry. Companies on average are looking to expand their workforce, and competition for key talent is going to continue to be fierce, unfortunately. Companies seeking to attract talent and retain this key talent need to, first of all, ensure their total compensation is in line with the market. They need to use performance-related bonuses to attract and retain these key workers. You ought to start considering being more flexible and creative in terms of the working environment, especially for Gen Yers. And I think this is the time to get serious about social media and mobile platforms. So having said that, I'll now pass it on to Jim Furin, who will take us through regional discussion of North America and the U.S. Thank you.
Thanks, John, and good afternoon, everybody. So I wanted to bring things a little bit closer to home, and following on from a number of the things that John said, look at some of the trends that we're seeing in the more local markets. So the overall picture in North America is that we saw some decreases and softening in salaries in 2013 for both local workers and imported talent. And really we've seen here declines in average salary that are in line with what we've seen around the world. So we're not particularly concerned that there's a negative trend there. We think that the decline in local salaries was a continuation of a trend that started in 2012, and it's pretty closely linked to the slowdown in drilling activity that we saw in the onshore shale market last year, mainly due to the reduced gas price as a result of oversupply, coupled with a significant reduction in rig utilisation due to technology advances, particularly in directional drilling. So we think these things combine to take a bit of the heat out of the demand for labour, certainly in the onshore market, and we saw that flow into wage levels last year. Expat salaries were far less impacted than the onshore market, as fewer expats were brought into the US in particular to work on the non-conventional plays, as there's a lesser pool of those around the world. So just having a look at moving on to look at where the expat workforce in the US is in comparison to the rest of the world. This slide shows a fairly steady trend. There's typically about a third fewer companies in the US that look overseas to source talent than elsewhere in the world. I'm going to mention a couple of things about the slide. Firstly, you can see that 2013 saw a pretty significant increase of companies seeking overseas talent of around 5 percentage points, and that followed 2 years of steady decline. I think that it gives us a bit of an insight into what happened in the market over the last 3 years, and we could say that 2010, obviously there was the Deepwater Horizon event, which curtailed the vast majority of activity in the Gulf of Mexico and reduced the volume of talent needed for offshore E&P work. Now, traditionally, a lot of the overseas talent brought into the US market would have been within these sectors. So that happened, and at the same time, the market shifted towards the onshore non-conventional plays, which require a very different skill set. And as I just said, there's very little talent out there in the world to bring in that space that's got a high volume of experience, possibly with the exception of Canada. And then towards the end of 2012 and into early 2013, the edge came off to the onshore drilling market, and activity started to pick up in the Gulf of Mexico, where we saw a greater uplift in the use of rigs, and that has brought in a larger need for E&P skills in those areas. So we've seen an increase in the import in talent over the last year or so. So I think what we see there is a strong trend with the general market activity. What we did see from last year's survey that we did was a very pronounced issue in the US oil and gas industry in terms of demographics and the high percentage of baby boomers that are advancing towards retirement age. Now, we've seen here that 2013 was the first time in the last 5 years where the number of companies employing expats in the US has increased, whilst elsewhere the trend has been either flat or decreased slightly, albeit marginally. And the anecdotal evidence we're getting from a number of our clients in the US is that they're being far more proactive around putting strategies in place to bring in key talent from overseas to help bolster their succession plans as the demographic issue is getting worse. So on the next slide, we see here the 5-year trend for the local imported salary and imported salaries in the US. You can see demonstrated here the rapid increase in local salaries from 2010 through 2011 as the onshore market hit its peak level of activity, and then that gradually drops down to its current level in 2013. The expat salary levels take a significant hit in 2010, assumably in line with the spill in the Gulf of Mexico, and then as that gradually increases through 2011 to 2012, we saw the increase I was talking about just now in activity in the Gulf of Mexico, and then the softening this year in line with the global trends. And then a quick look at global mobility. So what this slide shows is the top 5 countries of origin of imported talent to the US. Now, these numbers represent the percentage of the total expat workforce that are coming in from each location. Personally, I was quite surprised by the figures, as I thought we'd see 2 or 3 or 4 countries supplying a far higher percentage of the total. What this slide says is that only 10% of the expat workforce comes from the top 5 countries, and the spread and diversity increased last year as a greater percentage of companies looked for overseas talent. By contrast, this is very different to the picture that you get in a number of the other major oil and gas hubs around the world. In Australia, for example, you see between 17% and 25% of all imported labour coming from the UK over that same period of time. And in the UAE, where India provides between 35 and 42%. So I think you can read this a couple of ways. One is to say that we're very diverse in the US on where we're prepared to bring people into the country from, or where we're looking for people from. I think the other way to look at it is to say maybe we lack a degree of focus and strategy around exactly where we are trying to attract talent from around the world. And it's probably most likely a combination of the two. But I certainly do think it presents an opportunity for those organisations that are very open to bring expat workers into the US, and perhaps being a little bit more intentional about where they're trying to find people from and where the niche markets are for them. Just to take a brief look at how the traffic moves the other way, and again you can see that the US talent that does travel goes to a wide variety of places, with the top 5 destinations making up only 7.5% of the total. I don't think it's surprising that the Middle East is the top destination with the expat packages that they offer, but you can also see that Australia and Singapore increased rapidly in the last couple of years, largely as a result of the activity in the LNG markets, and I'd expect to see that decline next year as a result of the events this year. And then moving on, so just to take a look at the globe trotting Americans in a slightly different way, it's interesting to see that the trend here is that there's typically between a third and a quarter fewer American expats working around the world than the global average. So we import about a third fewer people. So we import about a third fewer people, which does actually bring a nice symmetry to the trend where there's a third fewer people being exported and we're importing about a third fewer. What I think this graph really shows us, though, is the lack of activity in the Gulf of Mexico through 2011-2012, and we saw a higher percentage of the offshore E&P talent head overseas for opportunities. And then in 2013, as the market has picked up here and it's softened elsewhere in the world, we've seen a large volume of them return home to look for good local opportunities, or as they've been demobilised from their roles overseas. So I think that means there could be a good opportunity to pick up people as they're returning home to the US from their overseas assignments, and companies here looking to pick up people in the offshore market should be considering that as a major part of their strategy moving forwards in 2014. And then so just coming back to look at benefits a bit more closely in the US, it's good news. It's good news in the US, and now over 70% of the US employees receive at least some sort of benefits package, which is a great increase on last year of nearly 5 points. Not surprisingly, the most widely offered benefit to the US employees is healthcare, closely followed by bonuses. By comparison, the top benefits offered around the world are bonuses followed by healthcare, and I guess that's not a surprise at all, given that more of the countries, international countries, offer local healthcare from the governments. So over the last 12 to 18 months, what we've experienced and we've seen is quite a dramatic change in how companies structure their compensation packages in virtually all the markets that we work in. Typically, the larger organisations have all had a lot more structure around how they have bundled their packages, but we've seen a far greater increase in smaller organisations starting to put getting a lot more organised around their compensation packages. They realise they need to start offering their existing staff more to retain them and be more competitive in the open market to attract new employees. I think the important message around benefits is that more and more employees are looking at the overall value of their package and less so at the pure financial components of it. In fact, we've seen trends that indicate people are actually prepared to take a decrease in base salary if the total package is right for them. Whilst it's not completely relevant here, we actually ran a study in our Canadian business last year that gave us a very clear insight into the fact that vacation allowance, for example, is a very important piece of the package, and that people would potentially move jobs for less salary, but they wouldn't for less vacation. And that feeds back into what John said earlier on about, in North America, people having a huge amount of value in work-life balance. And then looking at the forecast in the US for 2014 and the sentiment for the coming year, we've had a pretty good last 5 years. The market seems to have plateaued a bit in 2013. E&P has been very heavily invested in, and that's probably going to curtail a little bit as we find a bit of a shift going into upstream activity, from upstream activity rather into midstream and downstream. Certainly, there's going to be a greater focus on developing infrastructure to either increase production from existing producing areas or to enable production from newer regions. And we feel there's going to be a continued swing from onshore non-conventional to offshore activity, which will reinvigorate the hunt for talent in the subsea and drilling sectors. And so, to summarise, 2013 was a good year, although we did see salaries decline in line with global trends. 2014 is set to be another good year from a hiring perspective, with nearly 70% of employers set to increase headcount. And a larger number of companies recognising that they'll need to source talent from overseas. As with last year, Skills shortages remains the #1 concern for employers in the US, and in terms of achieving their objectives. So we think we're going to see a highly competitive market in 2014. It's going to be important for employers to ensure that you're able to compete for the top talent, which means having compensation packages that match the needs of your current and future employees. Remember that retention is as, if not more important than candidate attraction, and it definitely isn't all about cash. When sourcing talent, we think it's important to be intentional and have a plan around where you want to find people from and proactively target them. The most successful campaigns we're seeing certainly are being very specific and very focused, and I think that's important if you want to get the best results. And then when developing your sourcing strategy, as John rightly pointed out, it's very important to consider how your target audience looks for jobs in today's market. Your online profile is vital when developing your brand recognition, and it will maximise the returns from the wide variety of social media channels that get used as recruitment platforms these days. And that's something that we're personally spending a lot of time working on as well. And so that brings the presentation to an end. If you want to request a hard copy of the guide, you can email myself at jim.fearon@hayes.com, or you can request the information by visiting our website, which is listed on the slide there. So I'd like to say thank you very much, and we're open to any questions. Okay, so we've got one here that asks, which areas are you finding are in highest demand in the US from a skills perspective? I think I can probably answer that from two core areas. Across reservoir engineering and G&G, we've been having an ideal level of people that's been dubbed the Goldilocks level, which is typically candidates that are masters qualified with about 7 or 8 years experience. In reservoir engineering, it's really been people with experience in enhanced oil recovery and acquisition and divestiture. In geophysicists with experience in seismic interpretation and depth imaging experience, and then basin modelers. And then we've also seen particularly in the last 4 or 5 months, a significant increase with original equipment manufacturers and the service side of things, seriously trying to increase their business development capabilities. So the service providers are ramping up in a big way to leverage off what they think is going to be a good 2014 and 2015 increase their sales capacity. So I think that's what I'd say about that question. And then we've got another one coming in here. So I'm interested in what you say about the use of social media. What practical advice would you suggest around increasing our usage of that? And John, do you want to answer that, or shall I answer that?
Yeah, let me take a first cut at that. I mean, we have a relationship with LinkedIn and spend a lot of time on various social media platforms, understanding the trends, understanding technology trends, mobile technology as well. And some of the lessons we've learned is, first, it's critical to define who your target audience is. Who are you trying to target with your, let's say, social media efforts or candidate attraction efforts? So once that's been decided, then you can think through how best to reach that audience in terms of what platforms, social media or other platforms, in terms of what content, what sort of message is going to resonate with them. So what is the content and the messages that are most relevant and compelling to them to create and strengthen your brand? So that's probably the key message, is to spend time understanding who you're going after and how best to attract them, or how best to develop material and messages to engage with them. The dangers of not doing that is you can spend a lot of time and money developing content and putting it in platforms where you're attracting people that you're not particularly interested in. And we've sort of learned that firsthand, how much time and money and how distracting it can be. The other thing is the social media and technology platforms around the HR, human capital space are really changing pretty rapidly, and I think it does require some effort of people who have marketing expertise, digital marketing in particular, but also technology experience and recruiting experience, really combined to understand what's happening and how best a company should use the emerging trends in social media and how to adopt them. But it is, even for a company like Hayes, where we do nothing but recruit and attract talent, and we spend a lot of time thinking through the technology trends that are occurring, it's a confusing landscape. And without proper time and attention focused on it, I think you can go down a very deep and dark alley pursuing, not getting the return on your investment. Do you have anything to add on that, Jim?
No, I don't think so. I think that I would hasten to add that making your message consistent and continuous, and getting interesting information out to the people that you're trying to attract is absolutely vital, and we're seeing very good responses ourselves from doing so. So, I think that's a key message. Okay. So, any more questions? No, it doesn't appear as though there is. So, I'd say thank you very much for attending. Anyone, if you do have any other questions, then feel free to either email them through to us, and we'll get back to you. Otherwise, thank you very much. Goodbye.